Greetings, everyone. This video introduces you to Chapter 4. So at this time, I'd like to share my screen. Okay, Chapter 4 is on merchandising operations, and we'll be describing merchandising activities in this chapter. Up to this point, we have accounted for a service business. We make our revenue by providing a service. Okay, in a merchandising business, we buy and sell goods, and we sell what we call inventory. And for a merchandising business, the revenue is called sales, hence sales revenue. Now, part of being in the merchandising business, we have to sell our inventory, which is an asset, right? So when we give up our inventory is expired, right? We give it away, and that's called cost of goods sold expense. So the difference between what we sell it for and what it cost us is this thing called gross profit. And for a merchandising business, gross profit is very important. Okay, so this is how it kind of works. Notice that in a merchandising operation, there are two categories of expenses: cost of goods sold expense, and then operating expenses. So how does this work? Well, sales revenue is what we sell our inventory for, and the cost of goods sold expense is what the inventory cost us. And we sacrificed our inventory to make the sales revenue. So the difference between what we sold it for and what it cost us is this thing called gross profit. Okay. And then from gross profit, we will subtract our other operating expenses, and that will give us our net income. And for a merchandising business, the relationship between gross profit and our sales revenue is very important. You know, the managers take a good look at the relationship between gross profit and the sales revenue, and we'll talk about that a little bit later. Now, it looks more complex, right? But I have taught this concept to sixth graders. When I was in the CPA firm, they wanted me to go to Reedy College and be part of this career fair. And my job was to make accounting interesting for sixth graders. And I thought I was going to be in trouble, because on the right of me, I had Mr. Astronaut with the spacesuit, you know, from the Air National Guard. And to the left of me, I had Mr. Toothbrush, this gigantic toothbrush from this dentist. So how was I going to make sixth graders enjoy my presentation and get interested in accounting? Well, first off, I had a 10-key race, and I'd say, hey, psst, hey kid, come over here. And of course, if I did that today, I'd probably get arrested, right? They'd come over and I'd say, how fast could you flip these numbers? Because this 10 key is accountant's axe. It's just kind of like a rock star is to the guitar. Well, the accountant is this 10 to the 10 key. So anyway, the kids really got into it. And then when they were done, I would say, hey, would you guys like a new bike? I said, yeah. And I asked them, do you have any money? I said, no. Well, let's start a business. And I had this spreadsheet on a laptop, and I had the business was called Refreshments R Us. And I said, well, look, let's start this Refreshments R Us lemonade stand, and let's figure out how much money we can make. So I'd say, well, what are you going to sell your glass of lemonade for? Well, I'm going to sell for $1. Well, how many cups are you going to sell a day? They'd say, well, 100. So our sales would be $100. That's what we're going to earn from the sale of our lemonade, glasses of lemonade. The thing is, we have each glass is going to cost us, right? The lemonade mix, the cup. I said, well, how much do you think each cup of lemonade is going to cost us? And they would put like, well, how about 25 cents? Okay. So 25 cents times 100 cups. So there it is. Our cost of goods sold is $25. This $100 is our sales. This is what we receive from our customers. To earn that revenue, we had to give them the lemonade, right? And this is what that lemonade cost us, $25. So our gross profit would be sales minus cost of goods sold equals gross profit. Now I said, this is a big operation and you may need some help. So how about if you enlist your little brother to help you with a lemonade stand? Well, you're going to have to pay him $10 a day for him to sit out there with you and help you out. So that would be under operating expenses, wages expense of $10. But wait, you always heard that it's, location, it's really important. Well, the best location for your stand is in front of the neighborhood bully's house. So you make a deal with the bully, said, hey, I'll pay you rent if you let me put my lemonade stand in front of your house. So you pay the neighborhood bully $15 for rent. So there's rent expense of $15. So if we add up our operating expenses, it's $25. Well, how much net income did we make? Well, gross profit of $75 minus our operating expenses of $25. That's $50 net income. That's how easy it really is. Okay, so in the past chapters, we knew that to calculate net income was simply revenues minus expenses equals net income. And that's good. In a merchandising business, we have we're going to be selling inventory or selling merchandise. So we have these new accounts, right? We'll have an inventory account and definitely cost of goods sold expense when we sell the inventory. So this is what it kind of looks like. Net sales, and I'll talk about what net sales means. It's net of sales discounts and sales returns and allowances, but don't get too tripped up right now. Just sales minus cost of goods sold is gross profit. Think of the lemonade stand. This is what we sold our lemonade for. This is what the lemonade cost us, and that's how much gross profit we made. But then we had other expenses, like our wage expense for our little brother to help us, and also rent expense that we had to pay the neighborhood bully for the location. That will give us our net income. Well, what does that look like in terms of an income statement? Well, this is the old income statement, right? For a service business, it's super simple. Revenues minus expenses equals net income. In the merchandising business, it goes net sales minus cost of goods sold is gross profit. And then we take our other operating expenses to get our net income. Okay. So again, net sales, that's what we received from our customers or what we earned from our customers. And this is what the inventory that we sacrificed cost us, right? So we earned a gross profit of $5,592, but we have to include other expenses as well, like the rent and the wages and things like that to get our net income. Okay, so with that in mind, there are some things I'd like you to memorize. And you may not have a full understanding of what it is, but we'll be working with you on it. But right now, know that sales, less sales discounts, less sales returns and allowances equals net sales. Okay, so we know what sales is, right? It's the amount we earned from our customer. But we're going to make a deal with our customer that if they pay us within the discount period, let's say within 10 days, you're going to give them 2% off or something. Well, then you didn't really make the sale if you gave them a discount. So you have to reduce the sales for the early payment, right? That you received from your customer, that sales discounts. And then also you have to reduce your sales by sales, returns, and allowances. Returns is when your customer physically returns your merchandise back. Well, if they return the merchandise, you didn't make the sale, did you? So you have to reduce the sales by this amount. Allowance is kind of the same thing, but an allowance, they keep the merchandise and you just give them a little bit off of the price that you charge them. This would be typical if, there was a slight defect in it and you don't want them to take it back. I say, hey, if you keep it, we'll give you a little bit off the price. That's called an allowance. But both the returns and allowances reduce our sales to get our net sales. The next concept that I want you to know is the calculation of gross profit. This is pretty easy, right? Net sales minus cost of goods sold is gross profit, right? Sales is what we earned, and cost of goods sold is the sacrifice of the inventory that we had to give up, right? So we sacrifice our asset inventory, it becomes cost of goods sold expense. So this is what we earned. This is what it cost us, merchandise cost us, and that's how much gross profit we earned on the sales at this point, okay? Next, we're going to identify and explain the inventory asset and cost flows of a merchandising company. And, I read that, and you guys are newbies on this. You're probably thinking, I don't even know what you just said. Well, don't worry about it. You're gonna catch it as we go. But this is good. This is going to be good. Here we go. This is our inventory system, and it looks, oh well, this is getting hard. No, it's easy. Really, trust me. If you don't think it is easy, shoot me an email. Let me know. Hey, you lied to me. No, it is. Check this out. In an inventory system, you're going to start out with a certain amount of inventory, right? Beginning inventory. Then during the period, you're going to purchase some more. So at that point, you have amounts that are available for sale, right? So beginning inventory plus the purchases equals amount available for sale. Okay. So check this out. Let's say that we had beginning inventory of 1. We purchased 4 more. So how much we have available for sale? 1 plus 4 is 5. Now, at the end of the period, let's say that we only had 2 left in ending inventory. We had 5 available, but only 2 left. Well, if we had 5 available and only 2 left, how many did we sell? That's right, 3. That's all it is. From the amount available, you rather sold it or it's in ending inventory, right? And for one of the inventory methods, you're going to calculate cost of goods sold this way. It's going to be amount available of 5 less ending inventory of 2 is cost of goods sold of 3, right? You had 5 available, you had 2 left. That means you must have sold 3. Okay. I want you to memorize this. And you don't have to worry about net purchases. We're just going to say for now, purchases, and that's it. Yeah, purchases, it's going to be net of purchase, returns and allowances, net of the purchase discounts, and plus the freight in. But, let's just don't worry about it right now. If you caught me at River Park and said, hey, give me the cost of goods sold formula, I'd say this. Beginning inventory plus purchases is amount available minus ending inventory is cost of goods sold. Why don't you say it with me? Beginning inventory plus purchases equals amount available minus ending inventory is cost of goods sold. That's how easy it is. Now notice here, just like before, we had beginning inventory. We started out with 4. We purchased 1 more, so we have 5 available. Now there is a formula that we don't have that. That's an intermediate figure. Let's take that out and see what we have. I like this, but sometimes you won't need it to do your calculations. Most of the time you will, but sometimes you won't. So check this out. You can do the same thing by taking out that amount available. Just go beginning inventory plus purchases minus ending inventory is cost of goods sold. Okay. All right. So that gives you kind of a background. If you guys memorize that, then when you do your homework, it's going to make more sense. You can hang on to things. Okay. Right now, I'd like to do quick study 4-3 on page 181. So I'm going to end the show. And here we go. We're doing quick study 4-3 on page 181. Now, that's at the bottom, right? We are going to make some calculations for a merchandising company, which is McNeil, and then a service company, which is Krug. Okay, so let's look at A. In A, the merchandising company, that's McNeil. They want us to compute goods available for sale, cost of goods sold, and gross profit. All right, using these numbers. So take a look at McNeil Merchandising Company. How do you compute amount available? They say goods available for sale. I just like amount available. It's easier for my little mind to wrap around. But anyway, all it is beginning inventory plus purchases equals amount available, right? So beginning inventory is 5,000. You started with 5,000. You purchased 3,900 more. So you have available to you to sell 8,900. It's like we did before. Beginning inventory of 1 plus purchases of 4. Amount available is 5. That's how easy it is. All right. The next one, they want us to calculate cost of goods sold. Well, we're already almost there, right? Because I told you that to calculate cost of goods sold, it's beginning inventory plus purchases equals amount available minus ending inventory is cost of goods sold. Well, we've already got the amount available from number 1, right? So we're doing number 2. We'll just take that amount available, 8,900, and subtract the ending inventory of 1,700. And now you've got your cost of goods sold of 7,200. It's the same thing that we did just a little bit ago. If we had 5 available to sell, we only had 2 left in ending inventory, we must have sold 3. Again, here, we had 8,900 available. We ended up with only 1,700. Well, we must have sold 7,200 worth, okay? That's how it works. And finally, number 3, they ask us for gross profit. Well, what is the formula for gross profit? Net sales minus cost of goods sold equals gross profit. Okay, so we look at our numbers and net sales is 9,500, right? Well, we've already calculated cost of goods sold right before. So we just dropped that 7,200 into cost of goods sold and we got it done. Net sales of 9,500 minus cost of goods sold of 7,200 equals gross profit of 2,300. Okay, so that's 1, 2, 3. We are done with A. Let's go ahead and we can work on B, which is computing net income for each company. Okay, so let's do McNeil Merchandising Company. So it's really interesting because we've already done up to gross profit, right? We have net sales of 9,500 minus cost of goods sold of 7,200 is gross profit of 2,300. Well, let's put it in. That's the first part of our income statement. Net sales 9,500 less cost of goods sold 7,200. My gross profit then will be 2,300, right? 9,500 minus the 7,200 is 2,300. Now, all we have to do now is include all of our other operating expenses. And if you take a look, the expenses, the other operating expenses are 1,450. So put that in. So from the gross profit less the other expenses of 1,450, we have net income of 850. Okay. All right. Now, for the next one, this should give you a warm and fuzzy feeling because this is what we've been doing for the last 3 or 4 weeks, right? It's the service business income statement. Revenues less expenses equals net income. Well, let's put it in. Revenues, 14,000. Less expenses, 12,500. So net income, 1,500. Okay. All right. That's good. Let me go ahead then and we're going to do this not now, but just a little bit. So I'll advance it. I'm going to go back to my PowerPoint. All right. Now let's talk about 2 different types of inventory systems. One is the periodic. The other one is the perpetual. Now the perpetual is the one that we're going to learn. And it's interesting, in my day, because I'm an old man, we learned the periodic, and this was in the main chapter, and then the perpetual was in the appendix. Well, now because of technology, the perpetual is in the main chapter text, and the periodic is in the appendix. Now, why is that? Well, you know, today we have scanners, so we can track inventory coming in and going out very easily, right? So let's say that we have a supermarket. So we buy our inventory. Well, we bought it. We know what we bought. We can put it in so we can keep track of it coming in. That's fine. But because of scanners, we can also track it going out. So when you bring your groceries to the checker, they'll take a can of S&W green beans. They'll scan it. Shoot, there goes a can of S&W green beans for 99 cents. Then they'll take this milk. Shoot, well, there goes a gallon of Producer's whole milk. And it's really great. Now, when I was young and in school, there were no scanners. So when the checker would take the gallon of milk, they couldn't say, hey, it's Producer's milk and it's going out. They would just put, hey, it's going to cost $2.99 or whatever, and then charge us for it. But they have no way to know that it went out. Okay. But now we do. So in the perpetual system, inventory is tracked in and out. But in the periodic, in the old days, we couldn't do it. So we didn't track inventory. Matter of fact, when we bought inventory, we wouldn't even debit the inventory account. We'd do this account called purchases. And I'm not even going to go there because we're not going to really cover it. So we're going to cover this one where everything flows through the inventory account, the inventory coming in and the inventory going out. Now, in the perpetual system, cost of goods sold is known at all times, right? When it comes in, well, we bought it, we know. And when it goes out, the scanner tells us, hey, it went out. It's all good. But we still need to take an inventory count. Why? We have to make sure that there's certain things that we didn't know about, didn't happen or did happen. We have to check for theft and spoilage, right? So even though that we should know in real time what the cost of goods sold is and what our inventory balance is, we have to check for things like theft and spoilage. Now, in the periodic, we don't know what cost of goods sold is because we couldn't track it going out. So how do we calculate cost of goods sold? Well, remember that formula? Beginning inventory plus purchases equals amount available minus ending inventory is cost of goods sold. That's what we did. We knew what our beginning inventory was. We knew how much we purchased. We know we had 5 available for sale. And then when we did an inventory count at the end of the period, then if we had 3 left, we knew that we sold 2. That's how we calculated in periodic. Okay. All right. But remember, we're going to be concentrating on the perpetual. Now we're going to analyze and record transactions for merchandise purchases using a perpetual system. What I'd like you to do is to write this down. I just want you to know what's going to increase the merchandise inventory account and what's going to decrease the merchandise inventory account. The merchandise inventory account is going to be increased when you purchase inventory. You buy an asset and you put it in. So it's going to increase with the debit, right? Because merchandise inventory is an asset. But it's also going to increase by freight in, the cost of bringing that merchandise to your place of business. So it's not going to be freight in expense. You're not going to expense the freight charges. The freight charges are going to add to the cost of the merchandise. So if you pay freight, you're going to debit merchandise inventory. Keep that in mind. Now, what reduces inventory? Well, yeah, if you sell it, that's going to reduce it, but we don't even show that here. But these are the 2 things I want you to remember. If you return the merchandise, right, you give it back to the vendor, well, you've got to credit your inventory because you don't have it anymore. You gave it away. You gave it back. That's going to reduce the merchandise inventory account with the credit. There's also this thing called purchase discount for early payment. So if you decide to pay say you purchase it for, $100. So you're going to increase merchandise inventory here by 100. But then when you pay it within the discount period, you get maybe like 1% off. So you get a $10 discount. Well, if you get a $10 discount, that merchandise didn't cost you as much as you thought. So you're going to reduce the amount of that inventory cost, right? You're going to credit the merchandise inventory by that discount amount. And this is theoretical. I know you're thinking, boy, that's a lot to know. You'll see it when we do the journal entry, but I like this when you can just kind of see it, what increases merchandise inventory? Well, the purchase of the merchandise and the freight that you have to pay to bring it to your place of business. What decreases the merchandise inventory? If you return it or you are allowed to take a purchase discount for early payment. It didn't cost you as much as you thought. So you reduce the amount of your inventory. Okay, let's go ahead and do some transactions here. Purchases without cash discounts. Okay, we're not going to get a cash discount. Makes it easy. All right, on November 2nd, Z-Mart purchased $500 of merchandise inventory for cash. This is so simple. Take comfort in it. You're buying an asset, merchandise inventory for $500, and you're paying cash for $500. Super simple. This is a cash sale or a cash purchase, really. Yeah, for your purchasing it from your vendor. Okay, now don't panic. It looks crazy, doesn't it? This is what you'll receive if you buy merchandise on account. So basically, you're buying the merchandise and you'll tell the guy, I'll pay you later. So he invoices you because he wants payment. And it's usually going to be like 30 days from now. But let me go ahead and show you the components of this invoice. It looks kind of scary, but it really is not. First off, this is our vendor, Trex. This is who we're buying the merchandise from. Here on the invoice, this is us. We're Zmart. And so this is our name, this is our address. It's pretty easy, right? The date of the invoice is 11/2/15. So the date of the invoice is November 2nd. And can I just tell you something? I'm like, don't even worry about the PO date. That's not really important for us in this chapter. But the terms will be, you see these terms, 210 net 30. You say, well, what the heck is that? It says, if you pay me within 10 days, you can take 2% off. If not, the whole thing is due in 30 days. Okay, if you pay me within 10 days, you can take 2% off. If not, the whole thing is due in 30 days. Okay, so you can see down here that the amount that we owe is $1,200. That's how much we owe. Now, are we gonna have to pay that full amount? It all depends on when we pay it. If we pay within 10 days, we can take 2% off. Now, what is that time period? What is the discount time period? Well, what's 10 days from November 2nd? Well, 2 plus 10, that would be 12. So we have to pay this invoice by November 12th to take the 2% off. But if we do, we don't have to pay the full amount. We can take the discount. Now, if we miss the 10 days, then we have to pay the full amount in 30 days. So that would be 30 days from November 2nd. Trust me, I think it's December 2nd. So we have to pay this invoice by December 2nd. But if we pay on December 2nd, we miss the discount. So we have to pay the full $1,200. Now, in your book, they talk about this trade discount where they have a catalog and there's a list price. And they say you're a good customer and you can take 40% off the list price, right, of $800. We don't really give a rip about this, right? We don't care about the trade discount. We're going to just record the invoice amount. So we don't journalize or anything the trade discount. So just remember that. Trade discounts, not on invoice, not journalized. We're just going to do what we really owe, which is the $1,200 that's on that invoice. Okay. Now, this is a graphic of that discount period and the credit period. So I'm saying if it's 210 net 30, and if we pay within 10 days, which is the discount period, we can take the discount. So what we pay is actually the invoice price minus the discount. Now, if we don't pay within the discount period, we have till the end of the credit period, which would be 30 days from now, we have to pay the full invoice price, right? Now, I kept telling you about 210 net 30, okay? The reason why is this is a very common one, okay? You see this a lot in real life. So basically this says, again, if you pay me within 10 days, I'll give you 2% off. If not, the whole thing is due in 30 days. Can I say that again? If you pay me within 10 days, you can take 2% off. If not, the whole thing is due in 30 days. And I tell you what, 2% off in 10 days, that's pretty good discount, right? Most people do that because it's really good for them. And why would they offer such a good discount? Well, cash is the name of the game. Everybody wants money now. I don't know if you notice, you guys might be kind of young, but in business, people will take your money fast, but they're slow to pay you. And I'm an older guy, and I just seen it time and time again. So this is very common. They want their money fast, and they're willing to give you a discount for that. All right, let's go ahead and complete quick study 4-4 on page 182. On page 182, I'm going to stop the end of the show here. And here we go. Quick study 4-4, page 182. Now, in this quick study, we are given the amount that we owe and then the credit terms. And we're going to assume that for each of those credit terms that we are going to pay within the discount period. So how much are we going to have to pay? Well, that's what we're going to kind of figure out. For A, the invoice said $5,000 and the terms are 210 net 60. So if we pay within 10 days, which all of these we're going to pay within a discount, we're going to take the discount. We get 2% off. Well, what's 2% of 5,000? Well, 5,000 times 2%, it's $100. So how much are you going to pay for the invoice? 4,900. Isn't that great? You owe 5,000, but because you're paying within the discount period, you only have to pay 4,900, and they'll forgive you for the full amount. Now, I like to use the complement method, and this is my value added. I don't think you get it in the textbook, but check this out. You know the invoice is 5,000, and you know that you're going to get 2% off. Well, that means you're going to pay 98% of it, right? 100% minus 2% is 98%. We're going to pay 98% of it. So 5,000 times 98% is 4,900. Boom. Quick. There's your answer. This is maybe more intuitive. This is definitely quicker. Okay, let's do B. The invoice is $20,000 and the terms are 115 net 90. Well, we're going to pay within 15 days, so we're going to take the 1%. Well, what's 1% of 20,000? Well, 20,000 times 1% is 200. So what do we have to pay? Well, invoice minus the discount, we're going to pay 19,800. Now, if we use the complement method, we know the invoice is 20,000. We know we're getting 1% off. So we're going to pay 99% of it. So 20,000 times 99% is 19,800. Same amount. It just more quick, right? Let's go ahead and do C. Our invoice is 75,000. The terms 110 net 30. So we're going to pay within the 10 days. We're going to get 1% off. Well, what's 1% of the 75,000? Well, 75,000 times 1%. So that's our discount. So $750 is our discount. So how much do we pay? The invoice, 75,000 minus the discount. The amount that we're going to have to pay is only 74,250. Again, using the complement method, you know that the invoice is 75,000. You're getting 1% off, so you have to pay 99% of it. So just go 75,000 times 99%. That'll give you your 74,250. And then finally, the last one is D. The invoice is 10,000. The terms 315 net 45. So we're going to pay within the 15 days. So we're going to get 3% off. Well, what's 3% of 10,000? Well, 10,000 times 3%, that's 300. So how much are we going to have to pay? 10,000 minus 300 is 9,700. That's how we have to pay. Now the complement method, you think about this. We're going to get 3% off. So that means we're going to have to pay only 97% of it. So 100,000 times 97% equals 9,700. Okay, that's how it kind of works. I think next we're going to do this, but not yet, but I think I can get it set up for us. Okay, let's go back to our PowerPoint. Okay, this is purchases with cash discounts and the gross method. Ooh, that's gross. Sorry, little humor there. We're always going to use the gross method. And what does that mean? That we are always going to record what it originally cost us. We're not going to take the discount until we actually do later. There is a method, and I think it's in your appendix, where that your boss will tell you, well, you know what? We are always going to take the discount. It doesn't make any sense not to. And so you actually will record the discount up front, right? And then if you don't take it, then you'll have this discounts lost account. We don't do that. We're going to record it at the gross amount. And then when we actually get the discount, we'll take it then. So here we go. On November 2nd, Zmart purchased $500 of merchandise inventory on account. That means I'm going to pay you later, right? Or you're going to pay them later. The credit terms are 210 net 30. Now, let's take a look at this. If we want to get the 2% off, we have to pay within 10 days. Well, what's 10 days from November 2nd? Well, again, 2 plus 10, that's 12. So we have to pay this invoice off, this amount off by November 12th. Just keep that in mind. But right now, we don't really care because we're just going to record it at the full 500. So debit, merchandise inventory, 500, credit, accounts payable, 500. Now, we're going to pay within the discount period. And we said that it has to be by November 12th. And we did pay it by November 12th. So we're going to take the discount. Okay, so what do? We panic. No, we don't. We don't panic. What we do is we are going to be forgiven for the full $500. But because we paid within the discount period, we don't have to pay the full amount. We can take 2% off. Now, the way they did it, they did use a complement method here. They said that, well, if we get 2% off, then we only have to pay 98% of it, right? 100,000 minus, 100% minus 2% is 98%. So 500 times 98% is 490. So what you do is you're going to plug and chug. You're being forgiven accounts payable of 500, yet you only have to pay cash of 590. So we plug that $10 credit. So our debits equal credits, right? And the question is, well, why did we put it in merchandise inventory? You got to remember that we booked the merchandise inventory at the full 500, but because we're paying it early, the merchandise didn't cost us as much. We took the discount. So we're going to back that discount out of our inventory because our inventory didn't cost us 500. It only cost us 490. Now, if you wanted to do it the other way, you could have, to calculate this discount, you could have went, well, we're getting 2% off. So 500 times 2% is 10. And if you get this, then you can plug and chug the cash amount. So however you want to do it. Okay, so what does this look like? When we bought the merchandise, we debited merchandise inventory and we credited our accounts payable, right? We bought the asset. We told the guy, I'll pay you later. Okay. Now we're paying it later. So we're paying it on November 12th. And so we're going to be forgiven for the full 500. But because we paid within the discount period, we get 2% off. So, and what's 2% of the 500? Well, that's 10. So we're going to reduce our merchandise inventory by 10. Why? Because it really didn't cost us 500. It cost us 490. So that's why we reduce our merchandise inventory with the $10 credit. And then, of course, we only have to pay cash of 490, right? So that's how it kind of works. Now, what would happen if we make payment after the discount period? We said that if it's 210, net 30, well, what's 30 days from November 2nd is December 2nd. Well, so we're not late. It's 30 days from now, and that's the last day of the credit period. So we'll do it, but guess what? We have to pay the full amount. We don't get a discount. So we're going to reduce our liability, and we have to pay the full $500. Okay, let's go ahead and complete quick study 4-6 and 4-7. So I'm going to stop the share there. Quick study 4-6. Prepare journal entries to record each of the following transactions. The company records purchases using the gross method. It's always going to be the gross method, by the way. We don't do anything else. And a perpetual inventory system. That means that we're going to, debit and credit our inventory account. That's basically what it is. Okay. On August 1, purchased merchandise with an invoice price of $60,000 and credit terms of $310, net 30. Okay. So we buy it. We just debit merchandise inventory for $60,000 and credit accounts payable $60,000. Now let's keep in mind that if we want our discount, our 3% discount, we have to pay within 10 days. Well, what's 10 days from August 1? 1 plus 10 is 11. So we have to pay by August 11. And guess what? We did. So we get to take the discount. So on August 11th, paid supplier the amount owed from the August 1 purchase. So we're going to be forgiven for the full $60,000. Now we get to take 3% off. So I'm going to show you both ways of doing it. Let's say that we decided to do it to calculate the discount. Well, 60,000 times the discount of 3, we're going to get 1,800 off. So how much cash? Well, 60,000 minus the discount of 1,800 will give us our cash of 58,200. I put this in a box because that's your plug number, right? You have the 60,000, you got the 1,800, and of course, you know that debits have to equal credits. And so when you take the 60,000 minus 1,800, you get your cash of 58,200. Now, if you wanted to use the complement method to make sure that you were right, well, go ahead and do that. You know that you're getting 3% off. So you're going to be paying 97% of the 60,000. So what is that? 60,000 times 97%. That again is 58,200. So if you do it, the plug and chug way, this way, and then you do it the complement method this way, you know that you're right. This is how I would do it as a student, because I was I want to see all the angles. And so I'm teaching you all the angles. Okay. All right. And then let's go ahead and do quick study 4-7. On September 15th, purchased merchandise with an invoice price of $35,000 and credit terms of 2.5 net 15. Okay, good. Quick study 4-7, page 182. On September 15th, we bought merchandise inventory for $35,000. Debit, merchandise inventory, $35,000. Credit, accounts payable, $35,000. Now, if we want to get the discount, we have to pay within 5 days, right? 2.5 net 15. Well, what's 5 days of September 15th? Well, 15 plus 5 is 20. We have to get the discount, the 2% discount, we got to pay within the 20th. Dang it, we missed it. We're not going to be able to do it. So we're going to have to pay within the credit period, which would be 15 plus 15 that would be September 30th. We pay on the 29th, but nevertheless, we missed it. So we can't take a discount. We have to pay the full amount. So we're going to pay $35,000 and reduce our liability of $35,000. Debit, accounts payable, $35,000. Credit, cash, $35,000. Okay. All right, now I'm gonna move this up just a little bit. Can I do it? Okay. Let's go ahead and go back to my, I don't think I flipped my screen on you, did I? That's okay. I think you still see it. This is probably better though. Okay. Now we're going to talk about purchases with returns and allowances. Okay, let me just explain to you what a return is. Well, you do this all the time, don't you? You go buy a shirt at JCPenney's and you decide you don't want it and you take it back, you return it. That's what you do. So a return is where you take the merchandise and return it to the supplier. Okay, now you think about it, if you returned it, you don't have the inventory anymore, so you're going to reduce your merchandise inventory by it because you gave it back. Now the allowance, you keep the merchandise, but because of some reason they'll give you some price reduction. Maybe it was slightly defective and they don't want to take it back, so they'll give you something off. I got a great example of that. I had a friend who gave a present of $30,000 to his wife to remodel her kitchen. And part of that remodel was buying a commercial Sub-Zero refrigerator for $10,000. Can you imagine buying a refrigerator for $10,000? Well, if you got the money, I guess you can do it. Well, anyway, when they delivered it and installed it, there was a little scratch in the front. And my friend said, look, I'm not going to accept this. I paid $10,000 for this. I want you to take it out and give me another one without a scratch. And the vendor said, we really don't want to do that. How about if you keep it and we give you $2,000 off the price? Oh, you mean for that little scratch? Okay, I'll just put a little lemon oil on it. And he kept it. But that is what an allowance is. You keep the merchandise and the vendor will give you off the price. Okay, so let's go ahead and look here. On November 5th, Z-Mart, and we're the buyer, issues a $30 allowance from Trex for defective merchandise. Okay, so it's an allowance. So we're going to keep the merchandise, but they're going to give us off the price. So the merchandise doesn't cost as much as we thought. So we're going to reduce our inventory. And because it didn't cost us as much, we're not going to owe as much. So we're going to reduce our accounts payable. So debit, accounts payable, $30. Credit, merchandise inventory, $30. Okay. Now let's go over this. Z-Mart purchases $250 of merchandise on June 1 with terms 210 net 60. Okay, so let's go ahead and record that. Oh, you bought on June 1, you purchased inventory 250. So debit, merchandise inventory 250. Credit, accounts payable 250. And it's with terms 210 net 60. So we'll remember that. Matter of fact, let's just put it in our memory banks. If we want our 2%, we've got to pay within 10 days. Well, what's 10 days from June 1? 1 plus 10 is 11. So we have to pay by June 11th to get the 2% off. Spoiler alert, we are going to pay it on June 11th. Just remember that, okay? All right. Now, on June 3rd, Z-Mart returns $50 of goods before paying the invoice. Okay, we're returning our goods. Well, so we're going to return the goods. We're going to reduce our asset because we're giving it back a 50, and we don't owe it anymore because we returned it. Debit, accounts payable, credit, merchandise inventory. Now, when Z-Mart pays on June 11th, it takes the 2% discount only on the $200 remaining balance. Well, what's up with that? Well, remember, we originally bought the merchandise and we owed $250, right? But we returned $50 of it. That's here. So we only owe $200, right? $250 minus the 50. So we only owe $200. So we're going to be forgiven of $200. But wait, we're not going to have to pay that full $200 because we paid by June 11th the discount period. So we're going to be able to take the 2% off. Well, so what's 2% of $200? It's 4, right? So we're going to reduce our merchandise inventory by 4. So how much do we have to pay? Well, plug and chug. 200 minus 4 will give us our cash that we have to pay of 196. Now we could double check that as well, because we could go, okay, can I double check that? Let's see, how would we do that? It would be, we're getting 2% off. So that's 98% of what we owe. So it'd be 200 times 98%. That will give us our 196. Okay. So you can double check that. Okay. Let's go ahead and do quick study 4-5. Okay, so quick study 4-5, page 182. Prepare the journal entries for the following transactions. And we always are using the perpetual inventory system and the gross method. Ooh, that's gross. I know that it's a lame joke, but never gets old to me. November 5th, you purchase 600 units of a product at a cost of $10 per unit. Well, how much did you buy? Well, 600 units at $10, that's $6,000. So we're buying merchandise inventory of $6,000. And the terms of sale are 210 net 60. You know, when you see terms of like 210 net 60, you know it's on account. So in this case, accounts payable. 6,000. So let's figure out if we want to pay within the discount period, what would that be? Well, if it's 210 net 60, what's 10 days from November 5th? 5 plus 10 is 15. It has to be November 15th to take the discount. Spoiler alert. Yes, on the 15th, we're going to pay, so we're going to be able to take the discount. Meanwhile, let's go ahead and do number 7 on November 7th. We return 25 defective units from the November 5th purchase and received full credit. Okay, this time it's a return. Okay, so how much did we return? Well, 25 units at $10. So we're returning $250. And if we returned it, we don't owe it anymore. So we're going to reduce our accounts payable by $250. So on November 7th, debit accounts payable, $250, credit merchandise inventory, $250. The last one is on the 15th, pay the amount due from the November 5th purchase minus the return on November 7th. Okay, so how much do we really owe? Well, we owed $6,000, but then we returned $250 worth. So how much do we still owe? Well, 6,000 minus 250 is 5,750. Okay, so we're going to be forgiven. What we owe is 5,750. But wait, we get to take a discount. Well, what is it? Remember, the terms were 210 net 60, and we are paying it within the discount period. So what's 2% of that 5,750? 5,750 times 2%, that's $115. Well, how much cash do we have to pay? Well, plug and chug. 5,750 minus 115, we're going to have to pay $56.35. Okay, so that's our credit to cash. Again, why did we reduce the merchandise inventory for the discount? Because it didn't cost as much as we thought. It didn't cost as much. So we're going to credit that merchandise inventory. Notice that I gave you another calculation. You can do the old plug and chug, right? The 5,750 minus the discount would give us the cash paid, $56.35. But you can also check your work with the complement method, right? Well, if you're getting 2% off, that means you only have to pay 98% of it. So what's 98% of 5,750? Well, 5,750 times 98%, that's 56.35. It agrees both ways. You've got to be right. Okay. Okay. I think I'm going to stop the share. That would be a great place to stop for this session. So I hope you enjoyed it. And shortly I'll be giving you the next part of our chapter 4. Until then, happy studying. Bye-bye.